Hey everyone, as you've probably already seen by now, UiPath stock price crashed following its earnings release. But it wasn't all bad news. So I've highlighted a few factors that I think every UiPath stock investor should know. Not even if you're a UiPath stock investor, but if you're just interested in UiPath stock, if you have it on your list, if you have it on your watch list and you're waiting for an opportunity, these are things you should know about what happened in its latest quarter beyond all of those headlines that caused the stock price to crash. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right. So before we get into the details, I'm going to highlight here, of course, the two big items that caused UiPath stock price to crash was an abrupt change in leadership. The CEO suddenly resigned, and also the lowering of the annual targets for fiscal year 2025. So those are the two big headlines, right? But let's take a look at some of the other details that were somewhat overlooked because of the company's big news items that sent the stock price crashing. So one of the things here is the company ended the quarter with approximately 10,800 customers. Of course, UiPath is using automation and artificial intelligence to make businesses' jobs easier, to remove those redundant tasks that could be automated. And the main area is document processing. Things like, let's say, invoices or accounts receivable, things like that that are routine, everyday items, maybe for some businesses that really add up. If you've got, let's say, 17 invoices to send out and process every day, that can be time consuming, right? You accumulate that over a month, that can be over 500 invoices to handle every month. That takes time. If you can automate that process, that will reduce your cost, it will improve efficiency, and it will improve your relationships with your counterparties because you'll be processing documents more quickly. And so that's where UiPath steps in, and that's where it's been helping businesses worldwide. Additionally, UiPath's dollar-based net retention rate for the quarter was 118%. The dollar-based net retention rate measures how much customers spent with UiPath in this quarter compared to the previous quarter, right? So it measures if customers are increasing their spending with UiPath or if they're decreasing their spending. A number over 100% means that customers are increasing their spending with UiPath. And that's a good sign because that demonstrates UiPath offers an excellent customer value proposition. If you spend $100 and you don't feel like you're getting your money's worth, you're not going to increase your spending. But if you feel like you're getting your money's worth, you'll increase your spending. And that's a good sign for UiPath stock investors. Revenue also increased by 16% to $335 million, and remaining performance obligations increased by 22% to $1.1 billion. Remaining performance obligations are deals that UiPath has signed, and it only needs to perform the service in order to recognize these as revenue. It's always a good sign when you have remaining performance obligations growing faster than revenue. That means revenue is accelerating going forward, or revenue is likely to accelerate going forward if you persistently have remaining performance obligations growing above where your revenue is growing. The CFO also noted that their first half spend is timing related as they feel appropriately budgeted for the overall year. They expect to continue to drive strong cost discipline across the organization. And this is something UiPath has been doing really well. In mid-2022, they implemented huge cost-cutting plans, and those are benefiting the company now as revenue is growing. Costs are not growing as quickly, and that's creating leverage on the bottom line with revenue growing, profits growing, or the losses shrinking faster than they otherwise would. Now, UiPath is also generating strong cash flow because of those cost disciplines across the organization. UiPath also has a pristine balance sheet. As of April 30th, they had $1.9 billion in cash and cash equivalents and no debt, So they have $2 billion in cash with no debt. I've been saying several of these tech companies now have these types of balance sheets, and they have two benefits. Number one, UiPath can invest this $2 billion in super safe government securities, and that will earn UiPath roughly 5% annually. So you could think of that $2 billion in cash will result in roughly 200 million, or I should say 100 million in interest income for UiPath for a year. So 100 million just by putting this cash into super safe government bonds. It will also allow UiPath flexibility in terms with its customers. It can offer flexible terms because UiPath is not desperate for cash. If a customer says, okay, we'll sign this deal with you, but you have to give us 90 days to pay you instead of 30 days to pay you, UiPath can say, okay, we'll agree to that because we don't need the cash desperately right now. So those are the two benefits of these companies like UiPath that have these pristine balance sheets. They also are buying back their shares. They repurchased 500 million of their own shares at an average price of $23.46 between February 1st and April 30th. Now, that's significantly higher than where the stock price is trading at today, given the huge decrease following its earnings release. So UiPath has been buying its own stock, and I always like to see that from management going out and buying back their own stock. That signals they believe in their company. That signals they feel their stock is undervalued. And I wouldn't be surprised, given this huge stock price drawdown and the pristine $2 billion balance sheet, if they go out and buy more shares, or if they increase this authorization for how much they're going to buy back of their shares. So now to the headwinds. In mid-March, the company began seeing increased deal scrutiny and longer sales cycles with their multi-year deals. So they weren't closing deals as quickly as they thought they would close deals. And that started roughly in March and it continued in April. They are taking a prudent view on the contribution of these multi-year deals. And as a result of this impact to their revenue, they're going to reduce their non-GAAP operating income forecast and their non-GAAP adjusted free cash flow forecast for the remainder of the year. And as I highlighted in the beginning of the video, this was one of the two reasons why UiPath stock price crashed as much as it did following the earnings results, and the other one being the CEO resignation. Now, those two could be connected. The underperformance of these longer term contracts or these longer term sales or could have forced the CEO to be removed. I know it was a resignation, but sometimes resignations are somewhat forced. So that could have been a contributor. But overall, as you notice here, it wasn't just bad news for UiPath. The company still made strong progress. It still got a foundationally strong business model in an area that is helping businesses right now, because costs of labor are increasing and businesses are looking to automation as a way to save money and improve performance. The company has an excellent balance sheet. It's committed to buying back its shares. So I like the company longer term, even though I understand near term it's not going to be easy for UiPath to recover from this disappointing quarter. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.